Hello, everyone, and welcome back to another episode of Financial Market Insights for Traders. I'm your host, Sophia, and today we're going deep into one of the most fascinating areas of investing: advanced portfolio optimization. We're going to explore how strategies like risk parity and volatility targeting extend beyond traditional portfolio theory and why they matter for investors in today's unpredictable markets. Now, to set the stage, let's remind ourselves where portfolio management really began in the modern era. Back in the 1950s, Harry Markowitz introduced what's known as modern portfolio theory, or MPT. His insight was revolutionary for its time. He showed that investors don't need to look at assets in isolation. Instead, by combining them in smart ways, you can actually create a portfolio that offers the best possible return for a given level of risk. From this idea came the concept of the efficient frontier. But here's the problem. The assumptions that modern portfolio theory makes don't always hold up in the real world. MPT depends heavily on historical correlations, but those correlations can and do break down. Assets that appear uncorrelated in good times can suddenly start moving together in bad times. Think about the global financial crisis of 2008, when stocks, real estate, and corporate bonds all plunged together. Diversification that looked solid on paper vanished when it was needed most. On top of that, MPT measures risk using volatility alone. But volatility treats upside and downside swings as equal. Investors, of course, don't view them that way. We care about downside risk a lot more than upside surprises. And then there's the sensitivity problem. Small changes in assumptions about returns or correlations can lead to wildly different portfolio recommendations. So, while modern portfolio theory gave us an important foundation, it's not the full picture. That's why more advanced methods have emerged, methods that place risk at the very heart of portfolio construction. Two of the most important are risk parity and volatility targeting. Let's start with risk parity. At its core, risk parity is about allocating risk, not capital. In a traditional portfolio, let's say the classic 60-40 mix of stocks and bonds, equities completely dominate the risk profile. Even though stocks make up 60% of the capital, they usually contribute 80 to 90% of the portfolio's volatility. Bonds, being less volatile, contribute very little. This makes the portfolio overly dependent on the performance of equities. Risk parity takes a different approach. Instead of simply dividing capital, it looks at how much risk each asset is contributing. The goal is to equalize those contributions so that no single asset class dominates. That usually means allocating less capital to volatile assets like stocks and more capital to stable assets like government bonds. To keep overall returns competitive, leverage can be applied to scale up the exposure to safer assets. Here's a simple example. Imagine you're building a portfolio of stocks and bonds. Stocks might have annualized volatility of 20%, while bonds sit at around 5%. If you hold them in a traditional 60-40 split, stocks contribute the lion's share of the risk. But in a risk parity setup, you might flip that around: 20% in stocks and 80% in bonds. Suddenly, both are contributing roughly equally to portfolio risk. If you want to increase the portfolio's overall level of risk and return, you simply add leverage across the board. The advantage here is powerful. Risk parity gives you true diversification by spreading risk evenly. It also tends to perform better in crises because bonds often provide protection when equities fall. And over time, risk parity portfolios show smoother, more stable returns. The most famous example is Bridgewater Associates' All-Weather Fund, which was built entirely on risk parity principles and became one of the largest and most influential hedge funds in the world. Now let's turn to volatility targeting, which is sometimes called volatility parity. Where risk parity is about balancing risk across different assets at a point in time, volatility targeting is about balancing risk across time. The goal is to keep the overall volatility of the portfolio consistent. Here's how it works. You start by estimating the portfolio's current volatility, usually based on recent data. Then you compare that to your target volatility. Let's say your target is 10% annualized volatility. If your portfolio is currently running at 6%, you would scale up exposure to bring risk up to target. That might mean increasing allocations or even using leverage. But if your portfolio's volatility jumps to 20%, well above your target, then you would reduce exposure to bring it back in line. The beauty of this strategy is that it automatically adapts to changing market conditions. In calm markets, you're not sitting on the sidelines, you can safely scale up. In turbulent markets, you're not overexposed, you cut back. This creates consistency. Investors know what level of risk they're taking, regardless of what the markets are doing. The benefits are clear. Volatility targeting offers predictable risk control. It allows capital to be used more efficiently, and it de-risks portfolios automatically during turbulent times, avoiding emotional decisions. That's why it's a favorite tool among systematic macro funds and risk-managed ETFs. So, how do these two strategies compare? Risk parity equalizes risk across asset classes. Volatility targeting equalizes risk through time. They're tackling two different problems, but the two can be combined, and in fact, many sophisticated investors do exactly that. They start by constructing a risk parity portfolio across equities, bonds, commodities, and sometimes alternatives. Then they apply volatility targeting to keep the overall portfolio risk stable as markets shift. This way, the portfolio is both balanced in structure and adaptive over time. Of course, none of this comes without challenges. For one, risk parity often requires leverage, especially on the bond side. Leverage magnifies both gains and losses, so it has to be managed carefully. Rising interest rates can also reduce the effectiveness of leveraged bonds. Estimation is another challenge. Both risk parity and volatility targeting depend on accurate measures of volatility and correlation, but those measures are always backward-looking. Markets can change on a dime. Transaction costs are another concern. Volatility targeting involves frequent adjustments, and those trades can add up, particularly in volatile periods. And then there's the behavioral challenge. These strategies don't always outperform. In strong bull markets, a simple stock-heavy portfolio may do better, and that can tempt investors to abandon more balanced approaches just when discipline matters most. So, how do you get started if you're intrigued by these strategies? First, take a hard look at your own risk tolerance. Understand how much volatility you can handle and how much drawdown you can stomach. Then, experiment with simple implementations. You can try simulating risk parity allocations between stocks and bonds using common ETFs, or explore funds that already apply these principles. Finally, lean on modern technology. Having a powerful trading platform with built-in analytics and rebalancing tools makes all the difference when applying complex strategies like these. This is why a world-class, cutting-edge, user-friendly trading platform is so valuable. If you're serious about experimenting with or adopting advanced portfolio strategies, I recommend exploring crystalballmarkets.com. They've built their platform to make sophisticated trading and investing strategies more accessible. And if you're not quite ready to dive into implementation but want to build your knowledge base, another great resource is the Crystal Ball Markets podcast. It's beginner-friendly, covers everything from trading and investing basics to macroeconomic insights, and it's a fantastic way to learn at your own pace. So let's wrap this up. Modern portfolio theory was groundbreaking, but it's limited. Risk parity and volatility targeting take us a step further by making risk the centerpiece of portfolio construction. Risk parity ensures that no single asset dominates, while volatility targeting ensures that total risk stays steady over time. Together, they give investors portfolios that are both balanced and adaptive. For anyone who wants their investments to thrive across different market cycles, these strategies aren't just nice to know, they're essential tools. And thanks to the right platforms and educational resources, they're no longer just for hedge funds and institutions. That's all for today's episode of Financial Market Insights for Traders. I'm your host, Sophia. Thank you for spending this time with me. Stay disciplined, keep learning, and remember, putting risk at the heart of your portfolio is one of the smartest decisions you can make. Until next time, trade wisely.